Everyone's favourite topic in Unit 4 ATAR BME is financial ratios. The number of students who just skip it when given the opportunity is pretty high. But actually, if you can nail this one, often it's some really easy marks. So get on board. So the first part really is about the purpose and the purpose of using financial ratios altogether before we get into the three different types. So the overall purpose for a business is to analyze a business's financial position to be able to compare the actual performance of a business year on year to see if the business is actually improving its profitability, etc., or to actually compare its actual results with those predicted through things like strategic planning. It also allows the management of the business to assess their own performance to see if they're able to be profitable and managing costs in an effective way. So again, the two real ways that it can be used in the bottom part of the slide there is from management to see again if it's profitable and doing a good job with the overall financial management, but secondly through investors can look at things like the return on equity ratio to see if the business is a worthwhile investment by comparing it to other businesses in the industry or other types of investment overall. So the liquidity ratio or the current ratio helps a business understand its position in the short term to assess whether or not it can pay its short-term debts as they fall due. So we mean short term, basically within 12 months, and can it turn its current assets into cash to pay off liabilities which are due. Basically, if the current ratio is less than $1 of assets for every $1 of liabilities, the business has a cash flow problem and may not be able to pay its debts as they fall due. So ideally, in this situation, a business should have a ratio of $2 of assets for every $1, $2 of current assets for every $1 of current liabilities to show that it has more than enough cash on hand to pay its debts as they fall due. There are a number of profitability ratios that you need to address throughout the course, and profitability basically helps a business determine its earning capacity, and when we get to things like the expense ratio, also effective financial management. The gross profit ratio is gross profit over net sales, and it takes into account the cost of goods sold. So cost of goods sold is a tricky one sometimes, but it is really just the costs incurred for the direct production of the good or service. It is not operating expenses. So sometimes that leads to a bit of confusion from students, but cost of goods sold really is just those costs incurred in the direct production of the good or service. And that really leads to the best way to improve the profitability ratio, the gross profit ratio, which would be to reduce the cost of goods sold by seeking cheaper suppliers, negotiating better prices with suppliers. You could, of course, increase sales, but effective financial management would be to continually try and improve the cost of goods sold by lowering those costs. The profit ratio is how much profit is generated for every $1 of sales, and in this case, we take into account all operating expenses. So this is not cost of goods sold. This is operating expenses like the rent you pay on the premises, payroll, research and development costs, insurance, and marketing costs. So the higher the profit ratio, the better, obviously. And again, the ways to improve this ratio really is by taking into account operating expenses. So sound financial management, again, is always seeking ways to improve that through potentially more efficient use of the marketing budget, through moving to a smaller premises to save on those costs. So the expense ratio is sometimes tricky because this one, we want it to be small. So operating expenses over net sales is the calculation, and if the management of a business can minimize the expense ratio, it really does show sound financial management. because that's great. We want our costs, our operating expenses, to be as low as possible to really increase the profitability of the business. So if a business is successful in increasing sales and revenues whilst maintaining or decreasing its expenses as the business scales, this is a really good sign for effective financial management. So as we said at the start, the last ratio for profitability is the return on equity ratio, and it's calculated through the profit over equity at the end. So remember, equity is the amount of investment from a shareholder in the business. So it's really how that investment can generate profits. So if the return on equity ratio is high, this is great for both the business and for the investor, because it will ideally attract further investment. And again, this really is used a lot of the time by investors to be able to compare the performance of a business and the return the investor will get compared to other businesses in the industry or other types of investment, be it other shares, bank dividends, debentures, etc., etc. So the last ratio is the stability ratio, which is the debt to equity ratio, sometimes called the gearing ratio. And this identifies the amount of debt or borrowings the organisation has against the amount of equity invested. So the formula there is total liabilities over total equity. So here we would really hope a lot of the time for a ratio of less than $1 of total liabilities for every dollar of equity. However, it may change depending on the economic outlook. For example, if the economic outlook is good and the business goes into debt, having more liabilities in the short term to maybe expand, then potentially that is okay if over time it's brought back under control. If, for example, a business has, significant extra liabilities compared to equity, this is problematic, because then a lot of profit will go to potentially servicing that debt, which is not necessarily a good thing for a business. Okay, so in the 2024 exam, there was a question 9 in the extended response section, and this was probably made, I haven't looked at the examiner's report, but I would have a feeling that this was probably the least popular question, simply because of the presence of a financial ratios question. But if you looked closely at the question, it was pretty easy to get 9 marks, because all you are doing is simply commenting on the profitability of the business over 2 years. Not hard at all if you have a bit of an understanding, and the students who did do the question really smashed it because it's pretty easy. So here is the ratios that we're asked to look at, and we really are only looking at the profitability ratio, so don't be confused. There are 2 ratios there which are not relevant to the question. So if you would like to have a go at this one, then please pause the video and have a look at the information on the screen, or if you've got a copy of the 2024 paper, great. And when you're ready, pick up the video again and we'll run through the ratios you need to look at and the model answers. Okay, so yes, profitability was the only thing that needed to be commented on, and the bottom 3 were the 3 profitability ratios that needed to be referenced in the answer. Okay, so comment is a pretty, I guess it's kind of like explain. It's another version of explain, and the marks would be similar to an explain question. That only 9. So you weren't asked to do anything more than comment. You weren't asked to advise the business on improvements. All you needed to do is basically explain or comment on the ratios it had. So I believe it's always good to start any response with a bit of an introductory sentence, and you can see there in the model answer that profitability ratios measure the earnings capacity of a business. Interpreting the results for CHF, you then go into the 3 ratios which will be used. So in the meaning, I think, of the term interpretation, according to the syllabus and the way the examiner and the market determine it, is that you do have to show what has actually happened to the ratio over time. And in this case, you can see highlighted in blue there that the ratio has improved by 2% from 12 to 14%. And I also think that it's a great thing to do to write that out in words. And you can see that as the last part of the sentence there. So in 2023, for example, CHF, the business, had 14 cents of profit for every $1 of sales. I think that's a great way to show your understanding of the actually calculation of, or the formula for each ratio. So without reading through it all, you can see it's a pretty common response. So return on equity also increased by 3%, meaning that an investor would receive 8 cents of return for every $1 invested of equity. And then the expense ratio has decreased by 5%. This improvement can be understood as 55 cents of operating expenses for every $1 of sales. So, and again, I think it's always good just to round it off with a little conclusion, which basically, sums it all up by saying that the business is moving in the right direction because its expenses are decreasing while sales are increasing. And remember, if you read through the rest of the case study, this business was looking to move into Indonesia and potentially seeking investment, which the investors would be encouraged by its 11% return on owner's equity. So that is profitability ratios. That is all financial ratios, not just profitability. I hope it helps you better understand what is actually a tricky topic.